Coming up today, the US economy is growing faster than expected. Is the stock market pullback about to get worse? What's really causing semis to sell off? Could it be a summer of small caps? What is the bond market telling us? Commodities continue to pull back, and Earth just had its hottest day on record. Let's go, guys. And welcome back, Click Capital community. Thanks very much for joining me here today. Just want to start off by saying a huge thanks to everyone who gave me feedback on yesterday's video. Did get quite a lot of interesting comments. And stick with me today, because I'm going to respond to a lot of them and just clear things up a bit. And I'll be presenting that with some more interesting memes, so stay tuned on for that later on this video. First, let me get you up to scratch on what's happening across financial markets. We've got some continued weakness here in the main indices. S&P 500 did try and stage a rally today going into lunchtime, but turned sharply lower going into the close. Still not quite in oversold territory here on my S&P 500 oscillator. This indicator looks at a number of things, not just the technicals of the market. It looks at options, sentiment, market breadth. Quite a lot goes into it. And typically the bullish signals are much more stronger than the bearish signals. Like the one we just got a few weeks ago. The last time we got a bullish signal was back in mid-April when we bottomed there. And considering the stock market and all sectors are still above their long-term 200-day moving average. Typically when we get these short, medium-term oversold pullbacks, normally they're good buy the dip opportunity. Of course, no indicator is right 100% of the time. However, just looking at the odds, it does do a pretty good job at identifying short-term lows. Just looking at market color, still got that big rotation going on into smalls, out of bigs. Russell 2000 green across the board. Volatility still well bid, and we've got energy sharply bouncing back, green across the board. Only other major sector, healthcare, also uptrending. There's a look at my main technical chart, and if anybody's interested in importing my major watch list into your TradingView platform, I'll put a link in below this video where you can copy my monster watch list if you too like to get a broad-based view of global financial markets. And so we're not quite there in oversold territory on my dynamic swing index indicator either. It's only minus 6.6, and we're still a ways off the bottom of the buy-sell band, so we could still have a little further to go. Mega cap tech obviously pulling the indices lower. There's the composite chart of the Magnificent Seven. And just look at the price action and the Russell 2000 small cap. Still holding up really well there. A lot of action. Been getting a lot of big candles all over the place recently. Got a bit of a nice bump up in market breadth today. Still 61% of stocks above the 50-day average. And we've still got stocks hitting new 52-week highs, outpacing hitting 52-week lows. There's VIX still sitting pretty above 18, with the VIX 9-day even a little higher. Bit of backwardation there. Market forecasting some volatility in the short term. Even more so in the NASDAQ. That's broken out to yearly highs on the VXN, tracking at 24. Volatility. Getting a bit overbought here as well. Looking back in history, it's typically a good time to sell some option premium. Any stocks you don't mind owning at a certain price, you can sell some juicy puts if you don't mind the stock getting put to you. And on the other hand, any stocks you don't mind selling at a certain price, you can write some calls if you don't mind the stock getting called away from your account at that price. Applied correlations still sitting up there as well, but overall pretty low looking back in the long term. Bond market volatility still more closer to yearly lows than highs. And the skew index, price of out of the money puts versus at the money, still elevated and could still be approaching an area where we can make short-term bottoms in the market. There's a look at the price action and government bond yields, the 2-year, having dipped today. Didn't really react to that better than expected GDP print, showing the US economy growing at an annualized rate of 2.8%, higher than what economists had expected it to come in at 2%, and it was double what we saw in Q1 at 1.4. So normally, when we get hot economic data like that, showing the US economy is growing better than expected, bond yields can trade up. However, we're not seeing that today, and that's the bond market still forecasting the Fed to cut rates soon, most likely in September. However, we have got the 10-year trading a bit more firm, just above 420. And once again, the risky end of town in the bond market holding up pretty good as well. They're in high yield bonds. And same again in the dollar. Didn't really firm much off that strong economic data. We have been getting a big move these last couple of weeks in the Japanese yen. It was getting pummeled all year. It's really come back these last couple of weeks, even though the dollar hasn't fallen that much. Bitcoin had a bit of a dip down to the 50-day today. Quickly found buyers. Finished up just below 66,000 a coin. Ethereum, much more weaker. Just saw the ETFs come onto the market for the first time. However, that was off by about 5% today. And I think we could draw a support box in right around this area here, where the market has turned numerous times before. Commodities still a little soft here. Technically oversold. Gold now below its 50-day VWAP, and silver a bit weak as well. Getting a little technically oversold here in the short term. There's a look at crude oil, putting in a hammer candle formation, now trading above $78 a barrel. And copper, which has been hit really hard of late, trying to find some support down here as well. bit technically oversold. And here's a visualization of this huge rotation going on in the market. So just keep in mind, in bull markets, rotations are healthy. That's what we see in bull markets. Money goes from one area of the market to the other area of the market. What you see in bear markets is everything gets indiscriminately sold across the board. Mass liquidation. This is the rotation here into value stocks out of growth stocks. There's the equal weighted S&P versus the market cap weighted S&P. Rotating. Bit of an unwinding out of high beta stocks into low volatility. However, we have seen this action before. We're watching this support box here. And there's the monster rotation into small caps out of large caps. Once again, accelerating here again today. And there is a bit of a defensive rotation going on in the market. We can see that in the spread of consumer discretionary versus consumer staple stocks coming off, and that move into consumer staples versus S&P 500 shows there is a bit of defensive rotation going on. Still not much love for European stocks versus American stocks though. Trying to find a bottom. Credit spreads still holding up good, and inflation expectations still trading down as well. Looking at the best performing sector today, interestingly again, aerospace and defense breaking out to a brand new all-time high on really big volume. Like I said, we've been getting some pretty fat candles lately. Some big money sloshing around out there. Same again in regional banks. Walking the line, trading really firm here. Nice bounce back in the airlines today. And one area of the market I've got my eye on, and most likely going to make stock pick number 8 for my members, is going to be a small cap, health or biotech related stock. Seen really good price action in this sector. If we are going on a Fed rate cutting cycle, that's a good tailwind for biotechs. Does have a bit of a defensive component to it as well, along with healthcare stocks if we are going into a recession next year. Also got a bit of a perk up in energy stocks today, along with crude oil. But the weakest sectors, gold miners, as we've seen that pullback in commodities. And of course tech coming off hard, led by semiconductors trading down there, and I think we can draw in a bit of a support box right around where we traded today as well. Here's a look at the biggest stocks in the market. Apple reclaiming number 1 most valuable company, 3.3 trillion market cap. That's thanks to a bit of a nosedive from Microsoft these last 2 days. Now down at 3.1 trillion market cap, trading a bit heavy there. There's a look at Amazon, Alphabet, Google after their earnings yesterday. Traded a bit lower today. Same with Meta and Tesla, actually holding ground after its shocker earning the day before last as well. And just looking underneath the hood at all the sectors, there's financials trading a bit mixed. Energy mostly positive. Same with materials. Industrials a little bit mixed, same with transports. Consumer stocks also mixed, and seeing some of these other hot stocks like the GLP weight loss drugs, Eli Lilly also putting in some big candles, heavy volume this last week. Same deal with Novo Nordisk, large pharmaceutical, 580 billion market cap. But what I think spooking the tech sector is what's been leading it, and that's semis, having another pretty rough day out there. ARM Holdings, AMD, it's looking good, had a lot of bulls back on board just a few short weeks ago. Done a massive U-turn, taking out some multi-month lows. There's Qualcomm, got earnings in 6 days, and Broadcom as well, trading a bit lower. So like I've been saying recently, mega cap tech, Magnificent 7, especially semiconductors, did become such a hot trade. Traded up so much year to date, just until a few weeks ago, getting technically stretched. Same on valuations. It's not unusual to see a bit of a pullback, profit taking, rotation, all of that stuff. However, it could have the potential and risk to turn into something more. Maybe there's a reason why we're seeing these heavy volumes coming in, massive rotations, fund managers repositioning into other areas of the market. We did hear a bit over a week ago, comments from Trump saying that Taiwan should pay the US for defense. He said the US offers them a lot of protection, they've taken the US's chip manufacturing away, and they owe Americans something in return. And so I think that may be spooking investors in semiconductors, because if Taiwan loses the support, or even just a little bit of support, of the Americans, then they may become more vulnerable to a Chinese invasion. And the semiconductor industry, which Taiwan pretty much runs on, and still very important for American chip stocks, as a lot of manufacturing and fabrication comes out of Taiwan, could be a key pawn in a potential new US-China trade war. However, that's the bearish thesis. There's also the bullish thesis that this could just be a temporary scare, and whatever the new incoming administration is in America could potentially negotiate a favorable outcome and deal with Xi Jinping. However, what's also got me thinking is this guy here, Jensen Huang, who's actually born in Taiwan, regularly goes back, knows it better than probably all of us. He's been selling a lot of stock recently, along with other insiders on the board as well. Now that doesn't automatically mean they're worried about something changing in the political situation with Taiwan. Quite often insiders will sell for a lot of reasons, to make new investments, diversify their wealth, tax bills. When insiders buy, it's more significant, and they only buy typically because they believe the stock's good value. However, it's not a good look when Nvidia insiders have sold almost $500 million worth of stock just this month alone, as it was hitting new all-time highs. And there's Jensen Huang, who's been hitting the tape almost every day with hundreds of thousands of shares. And so no doubt, for whatever reason he's selling, that's probably spooking the market a little bit. Hopefully it's not because he's worried about something in Taiwan happening, which I would say is still low probabilities. Taiwan's just still far too important to America to let China go in there and take hold of things. I think Xi Jinping knows that. However, nonetheless, we have been getting these heavy candles in the semiconductor industry of late. Doesn't mean that it can't find support, just means that this uptrend is being tested at the moment and it will need to find support soon. However, outside semiconductors, I think what helped stabilize the stock market today is good economic data showing the US economy is still chugging along. Like I said, rose in the second quarter at an annualized rate of 2.8%. And there's a research note from Bank of America, which they titled, Second Quarter US GDP, What Slowdown? The economy remains on robust footing with an upside surprise on growth supported by strong consumption growth. Overall, the economy continues to disprove skeptics. Growth has certainly cooled relative to last year, but it has done so at a gradual pace. The risk of a sharp slowdown is low in our view. They said there's strong underlying momentum in the economy and that maybe the Fed can afford to wait, which I think is still a real possibility, that they may wait until after the election to move as well. But nonetheless, the US economy is still in an economic expansion. Just looking back in history over the last 75 years, we're currently 51 months into this one with a cumulative real GDP change of 20%. And again, looking back in history, expansions can go on for much longer, even 10 years or so. However, not everyone's so sure. Plenty of people still think there's a big bear hiding behind us, with them saying the stock market's cruel summer is about to get much worse, with technicals showing the short-term trend is bearish, and that's for sure true. Like I said, key sector of semis has definitely been tested. Big pullback in tech, massive rotation into small caps, but we're not seeing that huge bearish breadth across the board. If that was happening, that would be a much more clearer signal. Now we've got Fundstrat's Tom Lee, who I'd say has been almost clairvoyant these last couple of years. Of course, nobody gets it right all the time, but a lot of his calls have hit the nail on the head, and he's very bullish on small caps here, saying they'll surge 15% in August, with investors keyed in on a September rate cut and borrowing flexibility that would afford small caps. He also said while the AI narrative remains intact over the long run, investors focused on free cash flow or price to earnings will find small caps more attractive, and that's pretty much what I'm seeing as well. And just looking back at history at some seasonality of the Russell 2000 performance, 1 year off major lows, we're actually still tracking below that average performance, looking back in history here on the red line, with the potential for some more acceleration over the coming months. And we did just snap that really long streak in the S&P 500 of over 350 days without a 2% down day. Yesterday, it finished down 2.3%. Just looking back in history, when we finally get a 2% down day after we've had a long period of time without getting one, it's not necessarily a bearish thing. In fact, looking back in history, 6 months and 12 months later, the market's higher 71% of the time, with a year later the average gain 10%. Just looking at another technical pattern, when the Nasdaq index is above the 200-day moving average and the RSI goes below 34, like I said, by the dip in an uptrend, is a really strong signal. Like we've just got now, looking forward, the Nasdaq is up 1 year later 80% of the time, with a median gain of 13%. Also interesting to note is the correlations between the price action in the S&P this year and last year. 2024 here in the green, 2023 in the blue. So like I said, we could be in for a few months of consolidation, pullback, weakness. However, if we follow seasonalities, we should bottom somewhere in September or October. But we've still got to get through Q2 earnings seasons first. Did have a sharp pullback on Tesla. Also Ford, getting absolutely bushwhacked today. Missed Wall Street estimates. $1.14 billion loss in its electric vehicle division. Also having issues with warranty reserves. The company had to set aside to address issues with its vehicles, and they're just having a hard time in the EV space, which is likely to continue for years, and investors didn't like it one bit at all. Slamming the stock down over 18% today, finishing at the lows on massive volume, 259 million shares traded. Just moving over to the global macro, like I just showed you in the price action, government bond yields. Didn't really react to that strong GDP data today. Didn't really want to increase yields. Still a little tepid. We did get a little mixed data though. Even though GDP growth rate came in better than expected. Looking at durable goods orders, excluding defense, month over month, came in with a pretty big miss. However, on the other hand, initial jobless claims came in a bit better than expected. The big one tomorrow, personal consumption expenditures. First up in the morning before the market opens. With the core index year over year, 2.5% consensus, month over month, 0.1. Be really interesting to see what sort of print we get on this tomorrow and the market's reaction to that. Been a little while since we've had a print on some inflation data, so we'll get another look at that. And now Fed Fund futures are actually pricing in more than one rate cut in September. Just looking at the odds here, even given about a 12% chance, we may even have 50 basis points done by then. And in fact, they're now pricing in another cut in November and another one in December, and in fact 6 cuts all the way out to this time next year. Which, looking back in history, along with the inverted bond yield curve, which is quickly screaming back into uninversion territory, we could still be on the cusp of a recession next year. Really got to be watching the jobs market. once we see unemployment spike, there's pretty much no turning back. And if the inverted bond yield curve is right, it could be a pretty sizable recession as well. And so to get through recessions, which can often hit stocks really hard, and maybe long-dated bonds don't act as good a hedge as they used to, given the amount of debt the US government has, having some exposure to commodities is a good way to diversify and help get through a recession and bear market without seeing your portfolio dive 50 or 60%. However, for the here and now, we've got precious metals pulling back a bit, possibly reacting to that better than expected GDP data from the States, even though we didn't get a sharp rally in the dollar or bond yields. But again, investors small and large are just not positioned in commodities here. In fact, on some readings, looking at energy commodities, we're looking at positioning that is actually closer to max short, showing there's still a lot of money on the sidelines that could come into this space. And just looking at 10-year price charts of developed currencies, especially the commodity-sensitive currencies of Australian dollar and the Canadian dollar, like commodities, they've been in a decade-long slump. However, looking at the chart, we may be close to completing stage 1 accumulation, could be going into that sweet spot of stage 2 advance. And if commodities boom, so will these two currencies here, along with resource-related stocks in their markets. But for the here and now, oil is trading sideways. We're all still waiting for good numbers to come out of China, big consumer of commodities. And no doubt Goldman Sachs is right. The US will be an oil production powerhouse through at least 2026. It's the number one oil producing country in the world by far. Now actually produces more oil than it consumes. One of the first times in history. And even though fossil fuels, oil and gas is definitely not going anywhere for many, many years, we're still seeing a boom around the world in renewable power demand and governments moving more towards that. We got one of my favorites, NextEra Energy CEO, saying that renewable power demand will triple in the next 7 years amid the AI boom. They added 3,000 megawatts of renewables and storage projects last quarter, and they're working hard to meet the power demand from the AI sector and the huge amount of power and infrastructure that they need. And it's got the tailwind because whatever the cause, the Earth is definitely warming. In fact, the world just broke the hottest day ever on record twice this week, and that was beating the previous record set in July last year. It's been heat waves all around the world, America, Mediterranean, Russia, and there's a look at global temperatures over the course of the year, with each grey line representing a year between 1940 and 2022. And the light pink was last year, here in the dark red is this year. And so again, I know this is a controversial subject as well, clean energy, human caused climate change. However, I'm of the opinion, whether we're causing it or not, I think it's not a bad idea just to hedge our bets and go towards renewable energy, because either way, we're going to run out of stuff to dig up out of the ground, whereas renewable energy never runs out. Also, we can become much more energy secure, not having to rely on the Middle East, nor fund everything that goes on over there. And of course, I don't believe and wiping out thousands of jobs in the fossil fuel industry. There's got to be a good transition that considers everybody. But regardless of all that, I think there's huge economic opportunity in the clean energy sector, especially since it's been beaten down in a bear market these last couple of years. And I've just been getting some reversal signals here on the monthly chart on a major clean energy sector ETF. I think there is still some good value to be had. With this ETF even offering a dividend yield above 3%, there's a look at solar stocks, still beat down. Wind energy, beaten down as well. I think a bit of a sleeper sector, not many people really know about or talk about. I think could be a long-term winner. Hydrogen, also beaten down. Lithium and battery technology, clean energy technology, and of course EVs have been weak as well. Okay, just to follow up on yesterday's video, where I explained I'll be no longer sharing my political opinion on this daily market review. Just want to say huge thanks to all the feedback you guys gave. Got a lot of comments below the video. Got a lot of personal emails, pretty much all of it positive stuff. However, I just want to clarify and clear up a few things based on a lot of the feedback that I got. So first and foremost, I will still talk politics and how it relates to financial markets, as governments are the biggest forces in the market, and whoever gets into office will adjust our strategy towards. The only thing I'll be doing differently is I just won't be sharing my personal political opinion or any content here that can trigger some people. And on to my next point. Please don't think of me as a victim from the hate I've received. I'm far from it. And like we say in Australia, that's all water off a duck's back, mate. Also, I've learnt from working online that you got to have pretty thick skin. There's a lot of keyboard warriors out there. They'll hide behind their screens and come at ya, sling mud at ya, try and tear down your channel. However, these are the type of people when you see them in real life, they're like a little mouse hiding underneath a table. So it doesn't deeply affect me. That's just part and parcel of working online. And to be honest, I have shared some triggering content, so I do take full responsibility for that. And a few of you have said that I've been silenced and things like that. However, I really don't feel that way, as this is 100% my decision to no longer share my personal political opinion. I haven't been made to do it by anybody. I'm actually just refocusing the channel to what I originally wanted it to be and what I actually enjoy, and that's analyzing financial markets. I may have got a little bit too carried away with the US presidential election race, as it has been a bit of a diabolical one this year, and some things I feel strongly about I did share on this channel. And so just building on the theme I introduced a couple of weeks ago, where I was going to be more positive in my views of the market, instead of constantly filling all you guys with fear and 100 reasons to be worried, I decided to be more positive. And so I'm going to do that all throughout my content as well. What you're looking at here is the Noble Eightfold Path that comes from the teachings of Buddhism, which basically helps you to free your mind and get away from delusion. And so I don't want to be distracted from doing my job with having to deal with hateful messages all the time. I want to stay positive. I want to make the best financial content possible for you guys. And I really want to help everybody and not isolate anyone. And don't worry, I'll still share my personal opinions and beliefs that are positive and not divisive, as I'll try and be different from mainstream media, which in my opinion encourages hate, delusion, and division. So I'll still speak my mind. I'll still criticize governments overall. Pretty sure I can still post memes about Jay Powell and other funny and interesting observations on our culture nowadays. I'm still happy to share all that stuff. Things we can all enjoy and have a laugh at instead of trying to promote division. I'm just going to do all of this while being a bit more careful and smart about it, because I really want this channel to grow as big as it can without it being teared down by an army of haters. I hope all that makes sense, and I hope I have your support on this. And as always, you're welcome to drop a comment below the video. I know there's plenty of you guys out there I haven't heard from before, like I did yesterday. That was really nice to hear from some of you guys. So don't be shy and let me know what you think. And to all my regular loyal viewers, a huge thank you for sticking with me and supporting me on this. And as always, I always welcome and listen to your feedback and suggestions. It's really you guys that help to shape the show, as I'm really working for you. I'm analyzing the market and I want to stay focused on producing the best financial content and also helping my clients achieve the best results with all my products and services as well. So thanks for listening to all of that, and let's move on together on a more positive note. And with that, I'll wrap up the daily market review today. Thank you very much for tuning in. And like I said, tomorrow will be interesting when we get that print on PCE and how the market reacts to it. For now, still got monster rotations going on. Overall, things are still hanging in there okay. Thanks very much, guys, and I'll see you again tomorrow night. Cheers.